I think a couple of things matter when you look at the distribution of performance within the sector. The first one certainly is what your core business is, what you're focused on. The second one also is obviously where you operate. Certain banking markets have just done much better over the course of the past 12 months. And the third thing that matters is how big you are. And I think what came as a surprise perhaps over the past 12 months of this crisis is that very similar to every other industry, the largest players seem to have taken the lion's share of the gains over the past year. And I heard you mention, for example, Santander before. That's a classic example of a market leader that used the opportunity of the past 12 months to essentially solidify and grow their market share even further. But I think overall, as you mentioned before, things look much better than they did 12 months ago.
Have the banks been hasty, those that have written back provisions, have they been hasty to do that? We still, I think, have limited visibility on how this all ends, how robust the rebound is going to be, how well we manage to vanquish the vaccine, and just what kind of shape many businesses are going to be in once the financial support from governments is withdrawn. Do you think any of these banks have been a little hasty in trying to write back reserves, provision to reserves very quickly so that they can pay out larger distributions?
So I think you ask an excellent question, right? And I think conceptually the question that we're all asking ourselves is, how can it be that you have the worst economic shock in modern history, and yet the effect on European banks' balance sheet is very, very limited? But I think there's a number of answers to that. I think there's a structural answer. We forget that European banks have been de-risking their balance sheets ever since 2008. So you basically have had more than a decade of de-risking in terms of raising capital, changing the structure of your balance sheet towards low risk assets, simplifying your business model, simplifying your operations. And I think a large part of what we're seeing now is that the European banks that have entered the crisis in 2020 are very different to European banks that entered the crisis in 2008 or that entered the crisis in 2011. So I think that's a very important structural point. The second point is, it's very difficult to set aside more reserves or rationalize setting aside more reserves when there's actually a very limited default rate in your portfolio. I mean, let me just give you one statistic. We cover 54 banks in Europe. On aggregate, these 54 institutions have had a non-performing loan ratio of around 3% at the end of the first quarter of this year. When you count in the cash that they've set aside for these 3% of non-performing loans, that ratio falls to 1%. 1% of European banks' balance sheets that we cover today, on aggregate, is non-performing. I mean, this is a fraction of anything that we've seen at previous crisis peaks. And on top of that, the non-performing loan ratios are down year on year. So compared to a year ago, the portion of your book that is not performing has actually decreased. Right now, part of the reason for that is structural. Part of the reason for that is also just the reality of events, which also means that we have had extensive fiscal and monetary support for the economy and for the corporates. Now, I can tell you, being into the second day of this conference now, that the initial feedback from the bank executives, as well as from the regulators and supervisors of the sector, is optimism, both in terms of activity of the clients that they serve, both corporates and retail, until the end of the year, as well as consequently the performance of their book. So yeah, it is surprising just how well things have held up, but taking into account the structural factors and taking into account all of the policy response that we've had, perhaps we should be less surprised than we all are at this point.